Hello and welcome to KYC. This is Hira and with me is Varsha Chandani. Clearly, the show is meant for someone who really wants to look at a company from an investment perspective, and a long-term investment is what you should be thinking about. One company which is in focus on the back of everything that's happening, on the back of the weather in the country. The flu season is on, and that's where hospitals come into focus. Jupiter Hospitals is what we're talking about on this show. Let's quickly first understand what are the key questions that we are actually going to ask the management on the back of responses that we should be getting. First up, the company has been seeing a high depreciation. Now, the kind of impact it could have on its profitability growth on the back of the high depreciation is the first thing. Secondly, when you talk about their Greenfield projects, there are 3 of them that they're looking at. What are the kind of timelines that the company is looking at in terms of launch? Their target EBITDA margins is the next big question over the next 3 years, because that will actually tell you what's the operational efficiency when it comes to this company. And the growth in the average revenue per occupied bed. What is that expectation going to look like? Are they expecting growth, or will it remain stable at current levels, Varsha?
Well, on my list, I would want to know what is the sustainable debt levels that the company will have considering expansions, because recently they've added more debt. Number 2 is the total number of beds that they want to add, plus what is the capex that they are expecting over the next 2 years. And lastly, I would also want to know the revenue growth which the company is expecting over the next 2 years. So these are 3 questions on my radar.
Interesting ones, I think, that we will ask the management. But first up, let's understand all about Jupiter Life. Now, it's a multi-speciality healthcare provider, and it mainly operates in the Mumbai metropolitan region and the western region. Currently, around 3 hospitals is what they have, with a total bed capacity of around 2,500 beds.
Well, when we talk about hospitals, the main metric that we want to know is ARPOB, that is average revenue per occupied bed. For this company, it stands at around 67,300 rupees. Now, if you see over the years from FY22 to Q1 FY26, ARPOB has increased in a decent way, and that is actually important. So we would want to know what is the sustainable growth in ARPOB that the company is eyeing over the next few years. And also, so overall, so the 60, so as of FY25, if you see, ARPOB stands at around 60,600. And a healthy growth, about 6-7%, is what one should expect when it comes to ARPOB.
With this, the next important factor becomes your occupancy, because until and unless the occupancy is strong, you will never see that ARPOB improve as well. But now what's happened is your occupancy has declined by around 380 basis points. The reason for this is the new bed additions that the company has done, and that's the reason why you've seen that decline happening. But from a 54, it's actually gone up to 65.3% in FY25, which is absolutely encouraging. So that is a good number to sit with, because you're seeing improvement that's happening on the occupancy levels as well, Varsha.
Now, the main aspect when it comes to hospitals right now is the expansion. Every hospital is actually expanding when it comes to Greenfield and Brownfield. For Jupiter, if I were to talk about, 3 new hospitals are expected. One is Dombivli, where they're expecting 500 beds, 500 crore of capex is what they're going to spend, and it is expected to be operational by Q1 FY27. Then we have, Pune Hospital also, wherein the operation is expected by, calendar year 28, wherein they're going to invest 500 crore. And lastly, if I were to talk about their Meera Bhayandar Hospital, again, the approvals are underway. Operations are expected by, calendar year 29. So overall, 3 Greenfield projects that they are expecting over the next few years.
Interesting. Let's now decode Jupiter Life. All the factors that we will be considering over here, we're looking at the income statement. That is something that is going to be checked. The balance sheet, cash flows and return ratios. These are the top 4 parameters. Apart from these, you have the shareholding, street credentials, valuations, and the street coverage with outlook are the 8 parameters that we're looking at. But first up, when you talk about the income statement, let's understand, if you have to talk about the first quarter of FY26, clearly the impact was led by higher interest cost and depreciation, and hence we're asking that question to the management. The revenues, a 3-year compounded growth of around 19% is what they've seen. EBITDA also around 24%. Profits 56% in terms of the compounded growth, and hence a thumbs up, because over the last 3 years, the profit growth has been aided by higher other income. The higher growth that has come in from FY23 to 24 has been led by, again, a higher income and lower tax towards interest cost. The companies had higher interest cost in FY22 and FY23, and this reduced in FY24 and 25, and the debt in FY24 actually came down to 0, and hence we've given it a thumbs up.
Now, talking about balance sheet, now overall we have given a thumbs up. If you see, the borrowings as of FY25, stand at around 321 crore. But the company has almost 600 crores of cash as of Q1 FY26. So overall, on a net debt level, if you see, it's 0. Now, one of the reasons why we have given a thumbs up, and though the gross debt, if you see, is around 321 crores, this is the new debt that the company has taken because of the expansion that they are doing. So overall, a healthy balance sheet, I would say, considering the cash sitting almost 600 crore as of Q1 FY26.
And that takes us to the cash flows, which is also healthy, and hence a thumbs up, because your overall cash flow from operations has remained healthy. Your net cash flow has been negative in FY24, but that's mainly on the back of investing items. And when you talk about FY25, the net cash flow at around 345 crores is due to the cash flow for borrowings being positive, and the ratings given is on the back of the healthy cash flow, mainly from operations. So that's the reason why a thumbs up on this aspect.
Talking about return ratios, so overall, if you see the chart, except FY25, the return ratios, ROCs have been healthy at 21, 22%. The reason you're seeing dip in FY25 are because of 2 reasons. One is, of course, some pressure in profitability, and the company investing a lot. So there's been huge capex that the company has done. That's why the ratios are depressed. And the other reason is because of huge cash sitting on your balance sheet will also depress your return ratios. So overall, these are the 2 reasons why you're seeing 17% of ROC, and one of the reasons why we have given a neutral rating when it comes to ratios.
Okay, so that's return ratios, which is a neutral rating. Let's shift focus to the shareholding pattern. It's very interesting because overall, your promoters have absolutely remained stable in the last 3 to 4 years. Your FIs did see an increase. In fact, from a 4.17, they've gone up to 10. A minor sell has happened, and that number is at 9.77% in FY25, but it's almost the double of what they were in the March quarter of FY24. DIIs as well have steadily increased a small portion from 14 to 15.82 is what you're looking at in terms of the DIIs, and the public has also remained pretty okay. It's gone down though. Your free float has actually gone down from 40.76 to a 33.51, but a lot of promise from FIs and DIIs, and hence a thumbs up.
While, on the contrary, Hiral, the street cred, if you see, we have given a thumbs down because the company has not given much returns to their shareholders. In last 1 month, the stock is up only 4%, while in last 6 months, it's down 2.6%. Rather, in last 1 year, if you see, the stock has given only 7% to its investors. While if I were to talk about longer term also, in last 5 years, or rather since when the company has been listed, the stock is up only 42%. This is from 2023. So overall, a thumbs down, when it comes to the returns that the company has given to its investors.
Okay, so that's with regards to where the street credentials go. Let's look at valuations now. You can say that the stock is not very expensive and is not very cheap as well, because if you have to compare it to your peers, it's sitting somewhere in between. Narayan Hrudayalaya is the only one which is the cheapest out of the 4 that we've mentioned, and this is taking into consideration FY26. If you have to look at FY27 as well, a similar scenario is what you're seeing. Around 39 times is where Jupiter Life is, where Narayan continues to be the cheapest one, and you have Kim's and Globus, which are Global Health, which are still more expensive as compared to a Jupiter Life. In fact, even the other ones, from an Apollo Hospital to a Fortis to a Max Healthcare, it seems this is pretty much in between. And if you have to compare a Jupiter Life to a 3-year average as well, it's somewhere in between to the mid, to that range. So again, a neutral rating with the way it's sitting at.
Well, talking about analyst recommendation and outlook, so 6 analysts have rated buy, well, the potential lies at almost 14%. On the outlook, companies expecting organic growth to continue when it comes to, Pune and Indore with new beds and, of course, ramp up in those areas. And most growth will come from Pune, Indore until the Dombivli hospital comes online, and the ramp up of Dombivli, if you see, and the other hospital will be the key metrics to watch out. Lastly, if you see, increased depreciation and finance costs will actually have some pressure on PAT margin. So because of this, we've given a neutral rating, when it comes to analyst recommendation and outlook for the company.
Okay, so that's the overall. Let's look at what the picture looks like from here on Know Your Company. First up, 3 greens: income statement, balance sheet, cash flow, a neutral in return ratios. And if you have to talk about shareholding, again, it's 1 green. Street credentials is a thumbs down, and your valuations and street coverage and outlook are a neutral, which takes you to a 5.5 on 8, which is also a good rating so far. But let's get in. Ankit Thakker, MD and CEO of Jupiter Lifeline Hospitals. Ankit, welcome to the show, and always a pleasure to speak to you at NDTV Profit. We have these 5 or 6 key questions that we want you to talk about. First up, the interest and depreciation cost has been absolutely high, and that is what is impacting margins and profitability. How are you seeing the impact in FY26? And are you seeing that impact recede over the next couple of years? What is that trajectory going to look like?
Good morning. So, on the interest and depreciation side, I think you should expect the numbers to continue to look high over the next couple of years. We are currently in a serious capex mode. We are putting up 3 new Greenfield hospitals as we speak. The first one is in Dombivli, which is 500 beds, which will come up first quarter of next financial year. Then another 500 bedder in Pune and a 300 odd bedder in Mira Road in the MMR region. So over the next 2 or 3 years, there will be serious capex, and all of that will lead to increased depreciation in the times to come. On the interest side, we have currently, we are still net cash, but we have some debt on the book in anticipation of the 7th Greenfield project as well, which currently we haven't signed, but we are negotiating a few things. So if that comes up, then the 7th hospital may be partially debt funded, and that will also give rise to some interest component. While we have been debt free for the last couple of years, but going forward, we may have some debt on the balance sheet.
So Ankit, then what does this do to your profitability and to your margins over the next few years? Are you seeing any dip, or you think they will remain stable at current levels?
So I look at it, when you analyze the operations, I look at it more at the EBITDA level, which is more reflective of the strength of the operations. So on the unit EBITDA levels of the current operating hospitals, that is Thane, Pune and Indore, we don't expect any impact or dips. Indore, on the contrary, should grow and improve upon margins a little bit. But as the new hospitals come up, each hospital, would take a year or 2 to mature. So I would forecast maybe the first year to be slightly negative at the EBITDA level for each new hospital that comes up. The second could be neutral, and the third onwards, it starts contributing a little. So we are in this growth cycle, and therefore, the below EBITDA line items are expected to be higher than what they were.
Hi, Mr. Thakker. Varsha, this side. Pleasure to have you at NDTV Profit. Mr. Thakker, the occupancy, if you see, dipped in Q1, of course, because of the addition of new beds. How long do you expect the ramp up, or when do you expect the occupancy to reach at the peak optimum level, and what would be that level be?
So the peak levels generally for all the hospitals should be somewhere in the mid 70% of occupancy. Thane is already there. Pune is close. It is in high 60s. I think the next year also it should pretty much get saturated. Indore, you see a significant percentage dip in occupancy because of an expanded base. Like you pointed out, we have added close to 100 beds in Indore. So while on the absolute terms, the occupancy continues to rise, but on the percentage terms, you do see some dilution there. Again, we believe that in the next year also, once these occupancy numbers cross 60-65%, we have one more round of expansion possible in Indore. So we may add a few more beds in Indore, and then that will be the last of organic expansion as far as Indore is concerned.
Okay, so that's the overall expansion plan and what occupancy could look like. To add to this, let's talk about the average revenue per occupied bed. A good number that we've seen so far, I think, if I'm not mistaken, in double digits as well. Is this something which is going to be sustainable, taking the kind of competition that is coming in at play in the MMR region? Because a lot of other hospitals, in fact, majority of them are on an expansion spree as well.
Well, I think, and I have always maintained this, if you want to extrapolate the RPOP number, I think it is the safest to extrapolate it to grow in line with inflation. Anything beyond that, I would not guide or recommend you to build into your model. As far as, the growth in beds is concerned, I think it is still a lot to do with demand, a lot to do with unmet need. So I would not attribute the growth or the lack of growth in RPOB to competition, but I would attribute it more in terms to reality, which is that we are at an optimal pricing level. And like for all other things in life, inflation is a reality. The inflation is a reality for healthcare costs. So to that extent, our POPs will grow.
And also, Mr. Thakker, considering the expansion that you are doing, what would be the sustainable debt level, for at least next 2 years?
So the expansion which is currently underway, that is our journey from 3 to 6 hospitals. We are doubling our size. That will be completed free of any debt. So technically, we should be able to complete this round of expansion with the cash reserves that we hold on our books and the internal accruals that we will generate over the next couple of years. The debt is going to be used if we do the 7th project. So the 7th project then will be debt funded, and that will probably sit on the book for some time.
Okay. From here on, in terms of the capex that goes as well, we're talking about the expansion right now. How significant is the upcoming capex going to look like? Because the ones which are in the pipeline, everyone is aware of that. But if you have to look at any further additions, the 7th hospital you said probably could be funded through debt. What is that capex going to look like post that?
So depending on the land and location that we eventually finalize, our one thing that I can assure you and your viewers is that we are not changing our broad philosophy. That is, we are looking at a greenfield project, we are looking at Western India, and we are looking at the size of 3 to 500 bed scale. So within these parameters, depending on the land, location, etc., that we do finalize, we will be able to give you a better sense of what the capex will look like. But X of land, I think pretty much everything else remains the same. That is, we should see the project come up at anything between a crore and half per bed.
So Ankit, to take that expansion into consideration, what are the high growth specialities that Jupiter Lifeline could focus on? And currently, any percentage of your revenues that come in from high growth specialities? And do you see any opportunities lying there?
So honestly, we don't really track specialties as high growth, high margin, all of that. See ourselves more as community comprehensive health providers. We do everything from childbirth going up to cancer, organ transplants, all of that. I think it is not very wise in healthcare to really hair split these numbers and look at a P&L at branch level or specialty level. We don't consume that data even internally because I don't believe that there is any actionable insight that can come from that data. So, for example, if I learned that gastroenterology, for example, I'm just throwing something, is a low margin business. What am I going to do? I'm not going to shut it down. Yeah, we don't look at those numbers because we don't think those are actionable numbers.
Thakker, just wanted to have, so we are clear when it comes to EBITDA margins, but what kind of revenue growth are you expecting considering the expansions that you are going into? The revenue growth expected for the next 2 years.
So next year, with Dombivli coming in, that should add to the revenue on the consolidated level. Pune is maybe 2 or little more than 2 years away, so that will not figure into your 2-year projection. Thana should grow in line with inflation on the pricing front because the occupancy is pretty much matured. Pune also has a little bit of occupancy growth, so it can grow higher than inflation. And Indore has 3 levers besides pricing, occupancy. It also has a third lever of criticality of procedures or case mix optimization. So Indore should show the fastest growth of the 3.
Ankit, in the end, investors want to know what the return ratios are going to look like because you did a peak of 22% on a ROCE in FY22, 23. When do you come back to that number? How long will it take you? And anything beyond that that you're targeting?
I think you are the expert in that, and I think you
no, but
do
I'm
that
sure. I think
better
an
than me.
investor would want to hear from the horse's mouth because that is, something that will probably stick by.
Absolutely. So from the horse's mouth, I think what I very strongly believe is that I should do what I'm good at and I should do my job rather than somebody else's, which is to do 2 things. A, continue to run the existing hospitals well, efficiently, and in the best interest of the patient so that we continue our, operations well. And 2, make sound capex decisions for the future growth. So on that front, guidance from me can be limited to what we are planning to do next. We are planning to build 3 more hospitals and double up our capacity. You can, make an educated guess what double capacity can translate into in terms of financial performance. We can make sure that our capital allocation is not out of whack. We spend right amount of money. We don't overpay for things, and we are efficient in terms of capital employed. Eventually, that has to translate into returns if run efficiently. But I don't like making predictions on numbers. I would rather
Make
like giving
predictions on performance, I think. Thank you, Ankit, so much for joining us on the show. And that's Ankit Thakker clearly telling you as to what could be in store from here on. But very quickly, any key takeaways, Varsha, on this?
Yes, surely. So over the next 2 years, what he said was because of the depreciation, high depreciation, there going to be some pressure when it comes to PAT. Number 2, the peak occupancy level is expected at 70%. Soon they're going to go, they're going to reach at that 70%. And lastly, the ARPOB growth is expected or will be in line with the inflation. So
and they're going to take care of the returns to the investors as well. But thank you so much, for joining us on the show. To this, and that's all that we have on this edition of Know Your Company, only on NDTV Profit for Your Profit.